third presenter today will be Cortney Cowley. Dr. Cowley is an economist in the Regional Affairs Department of the Federal Reserve Bank of Kansas City. Her current research focuses on agriculture finance, commodity markets, farm management, and natural resource economic policy. Cortney's responsibilities also include writing the 10th District Survey of Agriculture Credit Conditions and the Federal Reserve System's Agriculture Finance Data Book. Cortney joined the bank in 2015 after completing her PhD in agriculture economics at Oklahoma State University. She holds a BS degree in biosystems engineering from Oklahoma State University, the other OSU, and a master's degree in civil engineering from Colorado State University. Dr. Cowley has been a presenter at the Ohio State University's Ag Lender seminars in the past and always does a fantastic job. Thank you for being with us today, Cortney. And at this time, I'll leave the program in your capable hands.
Okay, now I've got myself unmuted. Thank you very much, Ben, and thanks everyone for having me. As you said, I have presented at some ag lending workshops in the past. Always enjoy interacting with those of you in Ohio and at the other OSU, or I guess maybe Oklahoma State is the other OSU, I don't know, but always happy to interact with our colleagues out there. Today I'm going to be presenting on the ag credit condition and outlook. And I think that my placement on the agenda is very good, considering that, I mean, obviously it's difficult to follow Ani and Todd, but I think that they set up my presentation very well, providing a great overview of the farm financial perspective and farmland values, which are obviously two things that ag lenders look at a lot and that we look at a lot. I'll be presenting more from the ag banker perspective today to kind of follow up with what they touched on, but I would just mention before I proceed that the views expressed here are my own and do not necessarily reflect my employer, which is the Federal Reserve Bank of Kansas City and the Federal Reserve System. So just to start off, I wanted to give a brief overview of why an economist from the Kansas City Fed might focus on agriculture. 100% of my job is focusing on the agricultural industry for our bank, and I provide updates to our bank president on developments in the ag sector. And a big reason for that is shown on the map here. The 10th district, so the Kansas City Fed District, covers 7 states in the middle of the country that are very concentrated in agriculture. So including Nebraska, Kansas, Western Missouri, home of Todd Keithy there. I don't know if he's from the west or the east side though, but and then of the 12 districts, about half of them have ag credit surveys where they survey agricultural lenders on credit conditions, farmland values, and farm finances. Unfortunately, Ohio is located in the Cleveland district, and that's not unfortunate that you're in the Cleveland district. It's just unfortunate that they do not have an ag credit survey in that district. So a lot of the data I'll be showing today is from the Kansas City Fed District Survey of Agricultural Credit Conditions and from ag credit surveys from other districts. But I noticed that in Ani's slides, she listed some of the top commodities for Ohio being cattle and calves, corn, soybeans, wheat, and hogs, which are also the top 5 commodities in the Kansas City Fed District. So I think that what our bankers see is probably very similar to what bankers in the state of Ohio might also report. And then the chart on the right just shows that the Kansas City Fed District has the highest share of farm-dependent counties as classified by the USDA, and also the largest share of U.S. agricultural banks. So these would be commercial banks that have 25% or more of their loan portfolios in loans that go to farmers for production purposes or for farmland. So today I'll be talking about how the broader economy has contrasted a bit from US agriculture. So prior to the pandemic, we were seeing the two economies diverge. So the broader economy recovering from the last recession and the US ag economy being in a prolonged downturn. Economic conditions in agriculture have improved since the beginning of the year, but due in large part to government payments and more recently higher commodity prices, which have been a plus. Ag credit conditions did improve somewhat in the third quarter, up from sharp declines that we saw in the second quarter. But the outlook for the months ahead will depend quite heavily on the path of ag commodity prices and government support. And I know that both Ani and Todd talked about some of these things quite extensively, but I just want to point out that they're also important. These are things that ag bankers definitely look at a lot for their outlook. And so while I'll try not to repeat what what Todd and Ani talked about, there will be, I will just briefly mention some things for the context of ag credit conditions. So I wanted to start off with some of the comments that we've collected from ag bankers. So the Kansas City Fed, we host our own, the ag credit survey for our own district, but also for the St. Louis Fed, the San Francisco Fed, and the Minneapolis Fed. So I kind of collected some interesting anecdotes from our ag banker surveys in the third quarter, and wanted to share some of those just as to set up some of the other things that I'll be talking about. So you can see one banker in Nebraska talked about government payments that touches on not only the importance of where prices move, but also the timing and the ability of farmers to market their crops. We are constantly hearing from bankers that that farmers who excel at marketing or that hire people who excel at marketing tend to have weathered the storm of the downturn in the pandemic a bit better and are now having better marketing opportunities because of how prices have moved here recently. And then a banker in Kentucky highlighted that a large part of loan demand is not for new projects, but simply taking an opportunity to lower borrowing rates. And so this is something that has been a common comment, not just from ag lenders, but from businesses and lenders in for other types of loans as well, that because of the condition of the downturn, that that a lot of people aren't maybe wanting to invest in new projects yet, but are trying to take advantage of lower interest rates. And then another banker from Minnesota commenting on the rally in grain markets and more government support. That's been a pretty common anecdote that we've been hearing. But another perspective has been a focus on liquidity and working capital and how that is still a concern. And even though we do have government payments this year, the uncertainty moving forward, particularly in an environment where we have large crop inventories and uncertainty surrounding export markets, has really, I think, weighed on the outlook for ag credit conditions. And then another one on government support and the importance of Chinese trade. And then an interesting one I thought from Missouri this time that mentioned that a lot of farmers are exploring alternative crops for the future. Examples include barley for breweries, potatoes for potato chips, and cotton. And so that's something that I've kind of wondered through all this, as we've been seeing difficulties in over the last few years, particularly with some of the key commodity crops such as corn, soybeans, and wheat. This will be something I think to continue to watch moving forward, if maybe explore it. And before the pandemic, to go back a little further, there were some concerns in the agricultural sector with liquidity being expected to deteriorate alongside low farm profit margins. So the (2013) that prices for agricultural commodities had declined or faster than input costs for farmers, and that certainly weighed on working capital, liquidity, farmers' ability to repay loans. So, and then we had the pandemic, which significantly disrupted agricultural markets in several key ways. And the last few years, I think what has really driven the the downturn prior to the pandemic was the supply side of the equation, where we produced more than we could consume or export, which weighed on prices. Through all of this, but inside. So you had meat production that declined sharply in April and May as packing plants and meat processing facilities were forced to shut down and social distance and figure out ways to keep their employees safe. We also saw a huge shift in how consumers purchase food, which created some kinks in supply chains and difficulties just in getting, particularly meat from the farm to the consumer, which caused some price movements, so lower prices for producers, higher prices for consumers, and was just really disruptive to agricultural markets. And then on the crop side, we saw ethanol production decline sharply as people simply just stopped driving. And because of that, demand for petroleum and petroleum additives such as ethanol declined along with that, and is still, according to longer term projections, not expected to completely go back to pre-pandemic levels this year. So, however, the good news is that prices of most ag commodities have improved notably since April for most products except for cattle and broilers, which I think are still recovering from effects of the pandemic and are not benefiting as much from recent activity in export markets like what we've seen with corn, soybeans, and hogs. And so here I'm showing the percent change from January 2020 in prices. So the second quarter prices were down for all major agricultural commodities and remained down for most as of the third quarter average. But you started to see toward the end of the third quarter some increasing in prices and improvement in conditions, and that continued in through October. So also farm income, I won't belabor this because I think that Ani and Todd both covered it well. Farm income is expected to be much higher than a year ago due to ag government payments this year, and that's shown here in the light blue. So, but what are we seeing in terms of the banker's perspective? So here I'm showing responses to our Federal Reserve District surveys from bankers and how they're perceiving farm income in their lending areas for their farm borrowers. And so the dark blue, you can see Kansas City, and you can really see that these, for the most part, these lines pretty much follow the same patterns. So in the second quarter, we saw some pretty sharp declines in farm income in all Federal Reserve districts that have ag credit surveys, and then a rebound in the third quarter. But note that for all these districts, farm income still remains below 100, which means that a majority of bankers are still expecting farm income to be below levels where they were last year as of the third quarter. So even with, and I think that I don't have a chart on this, but you might be thinking, well, how is that the case when USDA numbers are showing higher farm income? Well, typically when bankers are responding to questions on farm income, they're thinking about profitability of farms, meaning that they're thinking about pure net cash income, which is revenues minus costs without government payments. And I've looked at this over a long time period, and our responses to banker comments on farm income are highly correlated to net cash income minus government payments. If you add back in government payments, the correlation is not as strong. So that's something to keep in mind when looking at our data and thinking about how bankers are thinking through some of the things going on in the economy. If you're not a banker, which I'm sure we do have some ag lenders on the line here today. So, but then again, government aid programs are expected to provide relief to farm finances. So in our survey, we also have the opportunity to ask special questions. And this is a special question from the second quarter where we asked about the level of support from government programs. And we asked about the coronavirus food assistance program and also the Paycheck Protection Program. And you can see that a vast majority of bankers, almost 90% in nearly all states, said that both of these programs provided at least moderate support to farm finances in 2020. But then again, farm borrower liquidity remains a top concern, and I think that that's because bankers are still kind of looking at, revenues, expenses, that the balance sheet of farm borrowers, and still in most states except for Western Missouri, which is highly concentrated in soybeans. And last week we got up to $11 soybeans, and I think that that has the developments in export orders from China and soybean prices have really boosted the outlook for ag lenders in that area of our district, whereas you can still see some improvement in most states, but still a majority of bankers expecting lower liquidity in coming months compared to the same time last year. So following multiple years of steady growth, demand for farm loans has also softened for the first time in a long time, while fund availability has surged. And this is something that you'll hear from a lot of bankers across all sectors, is that funds, they're just awash in funds right now because of, we've seen an increase in deposits and we've seen an increase in money on the market through programs at the Fed and from other programs on the fiscal side that have improved the fund availability at agricultural banks. But at the same time, and we've seen this across all of our surveys, we also have a national survey of terms of lending to farmers, and we've seen loan volumes decline in 2020 relative to last year. So, and part of that could be that farm borrowers are able to take advantage of some of the government programs and don't have as much need for traditional financing options. But it could also just be a result of weakness in the farm sector. And as I mentioned earlier, there's not as much demand for new projects or to expand right now. A lot of the demand is coming from the refinancing side. So in those types of environments, we tend to see loan demand decline. So due in part, again, to government aid, repayment rates, though, even though you saw on a previous slide a sharp decline in farm income in the second quarter, we really didn't see our similar index, our diffusion index for farm loan repayment rates decline as sharply. And so one of the thoughts is that, as although bankers are seeing from a, profitability perspective, still a great deal of weakness, particularly in the second quarter because of disruptions related to the pandemic, many of them had mentioned that repayment problems remained manageable. And a lot of that, I think that when bankers are considering repayment capacity of farmers and repayment rates, they are more likely to include government support in that. And so you can see here that farm loan repayment rates still remain below where they were last year, but have improved somewhat or stabilized somewhat. And then the degree of repayment problems even in the second quarter, which is when we asked this is another special question, the chart on the right, still remained similar to where it was a year ago, with only a slight increase in major repayment problems. So then Todd touched on this and Ani as well. Delinquency rates on farm loans have trended higher, but the increases have been modest. So here you can see that farm loan delinquency rates in the farm credit system have been flat, whereas at commercial banks, they've increased a little bit in 2020, but still remain below 3%. And this is for the US as a whole. As Todd mentioned too, the strength of farmland markets has supported ag credit conditions and farm balance sheets. And this is something that, everything that Todd talked about, this is just a chart kind of in solidarity with what he mentioned, just the fact that farm real estate values have been very stable and have given bankers and farm borrowers a lot of options, I think, even when times were very difficult on the farm income and farm profitability side. So historically low interest rates have also eased some pressure on farm finances. So interest expenses make up a very small portion of the farm balance sheet, but when margins are tight, any support, I think, can definitely make a difference. So as we think about low interest rates, we think about support to farmland values, but Then we also think about lower costs on the farm balance sheet as well. And so that can certainly provide support from multiple perspectives. And then over the past several years, expectations of long-term interest rates have also gradually declined. So if you go back to kind of the midpoint between the last recession and where we are now in 2015, current interest rates were they were very low, but even a little higher than where they are now. And at that time, the 3-year projection was that we would eventually normalize more and have interest rates, or the federal funds rate, around 3 to 3.5%. However, as everyone is aware, right now we again are back to closer to the zero lower bound, and the projection is that we'll stay there for the foreseeable future. So in conclusion, the potential for severe difficulties in agriculture associated with the pandemic has lessened for now. You know, obviously you'll hear, when you hear my boss, Esther George, or other Fed policymakers talk, they'll mention that the path of this recovery is significantly tied to the path of the pandemic. And right now we're not getting really good readings from the pandemic as it stands. You know, we keep breaking records on new cases, and we're certainly seeing that in our district. And I think something to follow now, particularly for agricultural communities, is that we're starting to see spikes more so in rural areas than we are in urban areas. And rural doesn't necessarily mean agriculture, and agriculture doesn't always mean rural areas, but still I think it's something to keep an eye on because the rural areas of the country are very important to agriculture, and we're starting to see more of an uptick there. So that could certainly be a headwind for the outlook for both agricultural finances, but also agricultural credit conditions moving forward. However, ag credit conditions did improve in the third quarter, but they did remain weak. You know, all of our indicators bounced back pretty sharply from where we were in the second quarter, but still indicated that a majority of bankers' outlook is still more pessimistic than where they were the third quarter last year. So concerns appear likely to reemerge, however, in early 2021 as government support fades, and you know, and who can say whether or not we'll have what the support will look like in 2021. And the outlook depends on underlying market conditions. I talked a lot about the demand side and how disruptive the coronavirus was, particularly in the second quarter. But what I didn't touch on was the supply side and the fact that we're still producing agricultural commodities at a very healthy rate in our country. And so the outlook will certainly depend on whether or not we're able to, for the demand to fit the supply side of the equation, and to keep markets elevated and prices where they've reached more recently. And so with that, I'd be happy to take any questions or hand it back to Ben.
Well, thank you. We really appreciate it. We did have one question come in. I don't know if you can answer it, but the question was, what is the impact of farming based on the anticipated priorities of the incoming administration? And I don't know if that's something that you're able to answer, but certainly did want to recognize that question coming in.
Sure. I think that one thing that I would highlight, and we don't know, everything that can happen or how much this administration will want to continue on what the previous administration did. I do know that the Biden group has seemed to be very favorable in continuing the developments in trade that we've seen. So trying to support trade, particularly for agricultural commodities. So I think that's good. I think the greater unknowns, however, are on the regulatory and renewable energy side, which could both be good, positive and negative for agriculture. So I think that there's still a lot of unknowns, but I do believe that historically, I think no matter which side of the aisle the administration falls on, that the House, which has a heavy hand in farm policy, remained how it is, and also that agriculture, I think, is broadly regarded as a very important industry in the U.S. And I also think that it's a positive that that most of the candidates being considered for USDA agricultural secretary are women, which kind of shows the willingness of the sector and those involved to allow other minority and marginalized groups to have a seat at the table and to have a voice. So I do hope that the ag sector as a whole continues to make that a priority as well. And so I think that that's a positive.
Excellent. Thank you. Really appreciate that.
Thanks for the question. Yeah.